Hi there. I have a new investment idea from a viewer, which is Big Lots. What's interesting about this company is that the market cap is around 66 million, and if you can believe, their total assets are over 3 billion. So when you compare their total assets of 3 billion with their market cap of only 66 million, you might say that this is quite a bargain. Moreover, if you look at their past revenue and earnings, you can see that this company, Big Lots, made over 177 million in 2021 in earnings. So 177 million in earnings. So this is more than 3x of the market cap, which is now about 66 million. What a bargain, right? And that's why a viewer asked me to analyze this company, to see if this company is really a bargain or not. As you can see, if you look at the stock price, year to date is down over 71%, and from the highest peak, this company is down over 96%. As you can see, this company had many ups and downs in the past. It has a long history, and let's see if the stock price can rebound back to $70 or $50, something like that. If that happens, then you can have more than 20x on your investment. More than 20x, if you can believe that. So, let's start the analysis. As you probably know, Big Lots, if you are from the US, is a retailer. They are selling different products: furniture, household essentials, grocery, toys, and others. You can take a look at their website and maybe you want to buy something. So let's start with the analysis. As I said, they have 3.1 billion in assets. If you look at their cash and cash equivalents, they have about 43 million, almost 44 million. So close to the market cap of 66 million. That's not bad. Then, inventories. The products they have to sell are worth over 900 million. So worth 900 million. Again, if you compare this number with the market cap of 60 million, this is a bargain. But of course, maybe they won't be able to sell all their products. Maybe they can sell those at a discount. So let's say half of their inventories may be valuable, 500 million. But still, it's a bargain. The market cap looks like a bargain. Now, if you look at their liabilities, especially their long-term debt, is about 573 million. So this is a red flag, their long-term debt. Of course, they also have other lease liabilities, over 200 million, and long-term lease liabilities, over 1.5 billion. So this is a problem. As this company has over 1,000 stores in the US, in 48 states, that is a liability for them because they have to pay rent, and they also have to pay employees, and of course for the products they sell. And you can see here their category by mix: furniture, soft home, seasonal, food, consumables, and hard home. So you can have an overview of this company, what they're doing, the stores they have, you can see the map here, and so on. But the most important, I said, is their balance sheet. Look at their cash and their liabilities. So as you can see, if you look at their assets, especially at their long-term debt, their balance sheet isn't that great. So this is a red flag, especially their long-term debt. Now, let's look at the revenue and see the pattern. Over the last 3 years, the revenue, net sales, have started to decline from 6.1 billion to 4.7 billion. And this trend has continued in the first quarter of 2024. Let me show you. As you can see here, May 4th, they reported a net sales of about 1 billion, a decline of about 10% from last year, when the net sales were about 1.1 billion. And of course, the net loss was about the same. They succeeded to manage their expenses, but still, their net sales are going down. So this is the second red flag, besides their balance sheet and their huge debt. Now, if you look, as I said, at this pattern over the last 3 years, the net sales are going down, but as you can see, their expenses, especially selling and administrative expenses, are going up from 2 billion to 2.1 billion. And this is bad. Quite bad. Because if they want to reduce costs and their sales are going down, they also have to reduce their administrative expenses. But you don't see any signs. They are going up. This is bad. Also, their depreciation is not going down. They've maintained about the same level. And also their gross margins are going down from 2.3 billion to 1.6 billion. And this is quite bad. Quite bad. So you have 3 red flags, as I said. Their balance sheet, bad balance sheet, declining sales, and growing expenses, especially selling and administrative. This is quite bad. And you can also see their final earnings. For the last 2 years, they reported a decline in their net income, over 200 million for 2022 and over almost 500 million for 2023. Only in 2021, they succeed to make almost 200 million. Of course, if they can rebound this business, reduce their costs, maintain their net sales, then maybe this company can again make about 100 million in earnings or 50 million. If they can do that, let's say they can succeed to make 50 million in earnings. But of course, they also have to maintain their net sales. So if they make 50 million in earnings, then the market cap can go to 1 billion or 500 million. As the market cap is now 66 million, you can have a nice increase, almost 10x, if Big Lots can deliver 50 million in earnings. Or maybe you can call this company Big Gains, especially if the stock price rebounds from the lowest level. That may happen, but as I said, everything depends on the management. If you can trust them, if they can maintain their sales and reduce their expenses. So far, as you can see, their expenses are going up from 2 billion to 2.1 billion. And this is quite bad. And by the way, this is not all. The 4th red flag for this company is competition. Be aware that this company, Big Lots, as you can see, their website doesn't look that great. This company competes with Amazon. And of course, other retailers such as Walmart, Costco, Target, Kroger, and many others. So they have over 100 stores in the US, but the competition is quite high. And as you can see, the revenue is going down. They are facing problems, lots of problems. We can also see that the comp sales are going down. And you can see their performance by category. Their comp sales are going down. This is another red flag. If you look at their capital allocation, it's nothing for shareholders because they are struggling to survive, to take on more debt so that they can pay the rent, their expenses, and maybe to stay in business as long as they can. Then you can also see their guidance. As you can see here, guidance for the second quarter, 2024, here. And they expect another decline in their comp sales, down mid to high single digit range. So a decline between 5 and 10%. They also are saying that they're trying to improve their margins, but as long as their sales are going down, you can forget about this indicator and focus only on their sales. So when a business, the revenue of a business is going down, this is quite bad, a red flag. Plus, you add on top of that the debt, and this is quite a risky company to invest in. Of course, they have different strategies to reduce their costs, take on more debt, to invest in their business, but you have to be aware, as I said, of the competition. They compete with big players, especially Amazon, Costco, which offers the lowest prices, Walmart, Kroger, Target. So the retail industry in the US is quite competitive. And I don't know if the management of this company can rebound this business to survive. As I said, it may happen. They might reduce their expenses, but as I said, so far, I don't see any signs. And their net sales might stop declining. If that happens, that will be a good sign. But so far, as you can see, they went down. They are going down. And also for the next quarter, it's expected another decline in their net sales. So if you want to invest in this company, be aware that the price may go down even more. Or this company may go bankrupt. As interest rates are so high, it will be quite hard for them to take on more debt. Imagine if interest rates go from 5% to 8%, then that will be bad for big lots and also other companies, of course. The entire stock market will go down, quite down. So it's up to you if you want to take this huge risk. And if you have other questions, then let me know in the comments.